The Russian bear has lost its bite. There was a time when a single decision in Moscow could send gas prices soaring and shake stock markets worldwide. But now that era is fading fast. Once the backbone of global energy and commodities, Russia is no longer the keystone of the global system. So what happens when a powerhouse grip slips away? On today's episode of the Infographic Show, we'll reveal why the world economy is turning its back on Russia. When the Soviet Union collapsed in 1991, Russia seemed destined for economic oblivion. But within a decade, resource wealth turned that around, making it a central actor on the global stage. However, the economic transformation was steep and often painful. Boris Yeltsin introduced things most Soviet citizens had never seen before: market-determined prices, privatization of state-run enterprises, foreign trade liberalization, and basic legal reforms around private property and commercial law. These were supposed to enable efficiency and bring in foreign investment, which was seen as essential for restarting growth. What actually happened was chaos. Removal of Soviet price controls caused hyperinflation in the early 1990s. In 1992, inflation soared to thousands of percentage points annually. The economy contracted, and Russia's GDP shrank by somewhere around 40% between 1991 and 1998. That's despite its abundant natural resources, large workforce, and industrial base. There were several reasons for this decline: rushed privatization, state enterprises sold off at fire sale prices, and weak banking and legal systems that lagged far behind economic progress. Also, institutions like the courts and regulatory committees that enforced contracts and business practices were weak. This created a volatile environment where corruption ran rampant. After the tumult of the 1990s, the early 2000s marked Russia's rebound. Global oil prices surged, and other commodities that Russia exported increased in price. The country built up substantial foreign exchange reserves and used the energy profits to pay off much of the foreign debt it had inherited from the Soviet Union. It's estimated that energy resources made up around 80% of Russia's GDP during this time. As Vladimir Putin took over, the government also reformed tax regimes and controlled inflation in a push for fiscal stability. Trade ties expanded. By 2008, the European Union accounted for over half of Russia's total foreign trade. Energy remained central, with the EU importing 185 million tons of Russian crude oil in 2007, along with roughly 100 million tons of oil equivalent in natural gas. Russia wasn't just a supplier, it was a gatekeeper. Moscow held enormous leverage, not just over prices, but over geopolitical and strategic decisions across the continent. The ability to throttle supply or hike prices meant Europe's markets could be thrown into turmoil with a single decision from the Kremlin. Agriculture remained important to Russian economic success as well. Russian wheat and fertilizer exports were massive. The pricing advantage coming from lower production costs, combined with a weakened ruble, helped solidify Russia's role as a global supplier. It was also one of the world's top producers of wheat, fertilizer, nickel, and other critical metals. Its dominance in metals like palladium, which is used in automobiles, fuel cells, jewelry, and electronic components, was especially important. But all of this growth came with strings attached. Russia's heavy reliance on energy exports left it vulnerable to oil price crashes, sanctions, and shifts in global energy policy. The nation's fiscal health was often tied to how well oil and gas were selling and how strong foreign demand remained. Meanwhile, other sectors, such as manufacturing beyond oil and gas, consumer goods, and services lagged in development. This was partly because energy wealth both distracted from and skewed incentives for broader industrialization. Corruption, weak legal enforcement, and uneven regional development further exacerbated structural vulnerabilities. Still, during its powerful rise, Russia's strategy seemed effective: extract value from natural resources, use the profits to stabilize the economy, build up its military, and exert geopolitical leverage. For a long time, that was enough to make the world economy feel that Russia was indispensable. So, what happened? When it comes to energy, Europe used to have a very simple and dangerous truth: Moscow pulled the strings. In 2021, Russia controlled nearly half of the European Union's natural gas imports, mostly via big pipelines like the Nord Stream, Yamal, both shut down in 2022, and Turk Stream. But after the invasion of Ukraine and the subsequent sanctions, Europe rapidly changed how it did business and where it sourced its energy. Today, instead of meeting nearly half of its gas needs from Russia, the EU's share of Russian gas imports has plunged to the low teens and single digits. This independence from Russian gas happened in just a few years. How did Europe pull off such a rapid decoupling? The answer can be chalked up to three factors: demand reduction, alternative supply, and energy transition. First, Europeans burned less gas. After the shock of 2022, governments and companies pushed hard on conservation. Industrial users optimized processes, power grids prioritized higher efficiency generation, and households insulated homes or shifted heating behavior. The International Energy Agency reported that Europe's gas consumption fell in 2023 to 2024 as renewables replaced some fossil fuel electricity. With less demand, Europe needed less Russian gas and oil. Second, Europe rerouted its supplies quickly. Liquefied natural gas or LNG imports surged. Tankers from the United States, Qatar, Algeria, Norway, and others filled the gap left by pipeline declines. By 2024, nearly half of Europe's liquefied natural gas imports were coming from the United States. This transatlantic pivot turned Europe's gas mix from pipeline-locked to globally flexible, a change that makes sudden political cutoffs far less crippling. Third, investments in renewable energy skyrocketed in Europe. Governments used the energy crisis to speed up wind, solar, and energy efficiency investments. Policy measures and emergency funds underwrote faster permitting, grid updates, and battery deployment. Renewables replaced a larger share of energy needs that had previously been gas-fired. The International Energy Agency even notes that the power sector's expansion of low-carbon generation was a key driver behind lower gas demand in Europe through 2024. However, these three trends didn't act in isolation. Instead, they fed on each other. Lower demand shrank the gap that new suppliers had to cover. At the same time, LNG from countries other than Russia reduced price swings and pipeline dependence. And with political will on their side, clean energy projects gained both funding and public support. But this reconfiguration also required massive scaling and upfront cost. Building or repurposing LNG terminals, signing long-term deals with faraway suppliers, and accelerating renewable energy pipelines all required major capital and broad political consensus. The EU and member states spent billions to secure winter supplies, subsidize storage fills, and underwrite infrastructure projects. Those costs were painful in the short term, but the insurance value of reducing vulnerability to a hostile supplier was deemed worth it. The European Commission has publicly set targets to fully end Russian gas imports by the end of 2027, reflecting both economic and geopolitical aims. This brings us to the big question: what does all of this mean for Russia's leverage over Europe? The blunt answer is it is shrinking fast. If Europe can replace suppliers with tankers from across the world and cut demand through policy and technology, then Russia loses much of its power to use energy as leverage. That doesn't mean Russian oil is out of the game, as it still exports to markets in Asia and retains some bilateral ties. But the era in which Moscow could reliably swing European economies with a pipeline decision has ended. But Russia's economic problems extend well beyond just the EU. Many other parts of the world have turned their back on Russia, and it's working out pretty well for them. Before 2022, Russian oil, metals, and fertilizers touched almost every continent. Countries bought Russian commodities because they were abundant and cheap. But after the invasion of Ukraine, sanctions and market shifts sent buyers racing for alternatives. And unfortunately for Russia, they found them. Once Russian crude oil covered around 10% of the global oil supply. Today, that share has narrowed, as producers in North America, South America, Africa, and the Middle East ramped up output. The United States reached a record 13.4 million barrels per day in August of 2024. Meanwhile, Brazil and Guyana boosted offshore production in the Atlantic. In Africa, new investments in Angola, Nigeria, and Namibia have expanded capacity, giving refiners options far from Siberian wells. Even Kazakhstan and Azerbaijan have increased shipments westward via non-Russian pipelines, bypassing Moscow's influence. For natural gas, Asian buyers have locked in long-term liquid natural gas contracts with suppliers like Qatar, Australia, and the United States. Japan and South Korea have doubled down on LNG terminals, while India is negotiating multi-decade deals with nations in the Persian Gulf. These flows have cut Moscow's room to maneuver. Its gas now makes up only a thin slice of new contracts signed after 2022. Russia's dominance in certain metals is also declining. Russian metals accounted for roughly 40% of global palladium and nearly 9% of high-grade nickel in 2021. But miners in Canada, Australia, and Indonesia have since scaled production. Recycling programs in the United States and Japan now reclaim more palladium from catalytic converters. For nickel, Indonesian smelters tied to Chinese investment are rapidly replacing Russian. Fertilizers have followed a similar path. Russia was the world's largest exporter of nitrogen fertilizer. Sanctions and export limits sent prices soaring in 2022, but production in nations around the world expanded to fill the gap, with countries like Brazil investing in domestic fertilizer plants. Even big customers like China and India, which are still buying discounted Russian oil and coal, are hedging their bets. China is investing billions in domestic oil fields such as Daqing and overseas projects. It's also accelerating its renewable energy rollout, where wind and solar installations hit new records. India has signed deals with companies in Saudi Arabia and the UAE to diversify crude oil imports. It's also working toward fertilizer self-sufficiency through domestic programs. Sanctions have reinforced these new market trends of a Russia-free world economy. Within days of the invasion of Ukraine, multiple nations froze transactions with Russia's central bank, slashing its access to hundreds of billions in foreign reserves. Major lenders were banned from clearing dollar to euro trades, while Russian banks lost access to several money management systems. Export controls hit the aviation, tech, and maritime sectors. Visa, MasterCard, Microsoft, Apple, and hundreds of global brands pulled out of Russia voluntarily. The U.S. banned Russian oil, gas, and coal imports outright in March 2022, and the U.K. phased out Russian oil by the end of that year. Even neutral countries such as Switzerland joined in with Western sanctions for the first time in decades, and Singapore imposed its first unilateral penalties in 40 years. But global sanctions weren't the only economic penalties Russia faced. Private companies divested en masse. BP, Shell, and ExxonMobil abandoned multi-billion-dollar energy stakes. McDonald's, Starbucks, Coca-Cola, and Pepsi shut down stores. IKEA closed shops. And even the International Cat Federation barred Russian cats from competitions. All of these forces have stifled Russia's ability to dictate prices or threaten supply. Countries across the world can now source energy and raw materials from multiple suppliers. Even as Moscow sells to some Asian partners, it does so at steep discounts. The world has moved from dependence to choice. Where once a disruption in Siberia could send fertilizer or nickel prices spiraling, today traders hedge their bets with cargoes from Chile, Indonesia, or the U.S. Gulf Coast. For most of the globe, the age when Russia's resources were unavoidable is fading fast. All of this is bad news for Russia, especially as its wartime economy begins to slow. Moscow's shift to wartime production briefly boosted growth, but that boom is fading, and the outlook is downhill from here. After its invasion of Ukraine, Russia shifted much of its economic machinery toward supporting its war effort. In 2023, GDP growth surged to 4.1%, followed by another strong year in 2024, largely thanks to military spending, a tight labor market, and elevated commodity prices. Government revenues jumped, while private consumption was buoyed by war-related payments and rising real wages. But by mid-2023, the warning signs were flashing. Sectors outside of the war economy, such as trade, leisure, real estate, and mining, started lagging sharply. Inflation accelerated, domestic demand surged unevenly, and Russia began running into labor shortages, infrastructure bottlenecks, and diminishing returns on high military input. By 2025, the war economy bubble was bursting. The IMF slashed its forecast for Russian growth by less than 1%. Quarterly growth numbers confirmed the slowdown. Inflation stayed high, hitting families and non-military firms hard. To keep it in check, Moscow pushed interest rates from 16% in 2023 to 21% in 2024, choking off credit and stalling civilian investment. Labor has become a major pinch point. Unemployment is at historic lows, but that doesn't mean enough people are in the right jobs. Russia faces several labor crises, such as a shrinking working-age population, large numbers conscripted into the military, and many migrants or skilled workers who emigrate. That erodes both the labor supply and the tax base, especially outside large cities. All of the war spending also needs financing. In 2024, defense spending hit levels not seen since the Soviet era, consuming a large chunk of Russia's budget. But revenues from oil, gas, and metals are more volatile than ever. As energy prices softened and export routes narrowed, the terms of trade have deteriorated. Government borrowing is rising as well. In 2025, Russia revised its growth forecast downward because high interest rates and credit costs dampened private investment. Budget deficits are growing, and debt servicing now claims a larger share of government revenue. Domestic bond issuance is one of the few remaining tools to fund the war, given restricted access to international capital markets. While the military and defense industries are prioritized, the civilian sectors are declining fast. Real estate development, domestic trade, and services like hospitality and leisure have all seen steep slowdowns. Investment in consumer goods and infrastructure outside of military necessity is drying up. Meanwhile, households are getting squeezed as inflation erodes purchasing power and many goods are scarcer, especially imported tech and luxury items. Even when real wages rose in some sectors in 2024, that was largely among workers tied to military supply chains or war support. Other workers saw stagnation or decline. Putting this all together, the indicators now point toward a serious risk of recession. Economists have warned that unless monetary policy eases and borrowing costs drop, the economy may contract more sharply. Growth forecasts for 2025 are now centered around 1.5%, with some analysts seeing possible zero growth or mild contraction if external pressures worsen. If military spending continues to dominate fiscal priorities, then trade-offs will be unavoidable. Either Moscow will need to divert funds away from war or allow civilian suffering and economic decline to deepen. And if Putin's prior policies are any indicator, he is more than happy to let the Russian people suffer if it means getting what he wants. This brings us to what a world economy without Russia would actually look like. The move away from Russia by the world's nations has led to countries with energy and mineral exports to profit, while renewables continue to chip away at fossil fuel demand. Supply chains for metals, fertilizer, and grain now have far more options than they did just a decade ago. That means price swings triggered by Moscow's policy choices have far less impact on global markets. A continent of customers who once answered to the Kremlin can now shrug off a dictator's economic threats. For the global economy, this transition has two major effects. The first is about leverage. Resource choke points, like the ones Russia once controlled, matter less. Instead, power is shifting toward countries that dominate capital, advanced technology, shipping, and finance. Second, market resilience improves. Buyers can work around disruptions and prices reflect a broader set of risks, rather than a single source of supply. The transatlantic energy relationship with the United States emerging as a key supplier of oil and LNG is more than just a temporary workaround, it is a structural change that permanently reduces the value of Russian energy. This global reconfiguration leaves Russia with far fewer good options. Demand for its exports is eroding, and energy revenues are smaller and more volatile than before. With markets diversifying, Russian producers increasingly sell at discounted prices or to a shrinking circle of buyers, all while domestic taxes and war-related levies cut into corporate margins. Financial isolation and technology gaps add to the pressure. Western sanctions continue to block access to international capital, high-end equipment, and even insurance for shipping risky cargoes. Trade may be rerouted through China, India, or the Middle East, but this is really a small band-aid for a really big problem for Russia. Analysts argue that Russia's economy is weaker than official figures suggest, with sanctions directly undermining its ability to modernize industry and fund trade. Demographics make the future for Russia's outlook even bleaker. Long-standing problems of aging and low birth rates are now amplified by immigration and mobilization, creating a shrinking pool of skilled workers. This will drive up labor costs in civilian industries and limit the country's ability to move from a resource export model to a technology or services-based economy. The result is narrowing policy options for Moscow. Looking forward, three broad scenarios take shape for Russia. The most likely is a slow slide into deeper isolation. Sanctions remain firm, Western financing and imports stay off limits, and military spending crowds out civilian investment. Growth could stagnate or even tip into modest contraction. If this trajectory continues, Russia's economy narrows instead of diversifies. Productivity stays low, the country leans more and more on a small circle of partners, and ordinary Russians see their real incomes decline. A second, more adaptive path would see Moscow doubling down on trade with China, India, Turkey, the UAE, and other non-Western partners. That might stabilize output enough to avoid a deep recession, but it comes at the cost of lower prices, less investment, and deeper reliance on those partners. The most ambitious and least likely future for Russia would be a strategic reintegration with Western markets. It would require sweeping political and economic reforms, as well as credible steps toward de-escalation. And it is the hardest scenario to imagine, but it's also the one that could revive the Russian economy and turn growth away from war spending. If Russia's footprint continues to shrink, the winners are clear. The United States, the Middle East, along with Africa, Latin America, and Asia, will capture a bigger share of global energy and commodity flows. Markets will become more flexible and diversified, and influence will increasingly pass through networks that had previously been overshadowed by Russia's massive energy and mineral reserves. That doesn't mean Russia disappears. It remains a large regional power with a vast arsenal and significant resource wealth. But the era where a single decision in the Kremlin could send global prices spiking and capital scrambling is at an end. Europe has slashed its dependence on Russian gas. Global markets have found new suppliers for oil, metals, and fertilizer, and sanctions have walled off much of Moscow's financial reach. A war-driven economy is straining under inflation, labor shortages, and shrinking revenues, while GDP growth slows. Looking ahead, the global economy will keep rewarding flexibility and cooperation over raw resource dominance. Russia faces a choice. If it cannot move beyond militarization and discounted exports, then its future won't be about setting global prices. It'll be about fighting just to keep a foothold in a world that no longer needs it. The world economy might not need Russia anymore, but the country itself is full of surprises. Watch 50 insane facts about Russia you didn't know to learn the shocking truths hidden behind the headlines, or click on this video instead.